Hey everyone, today I'm diving into a hot topic that's been making waves in the finance world, the Chinese banking crisis. Why are banks in China crashing, and what does it mean for America? Stick around and let's break it down. First off, let's look at what's causing the turmoil in Chinese banks. Just like the savings and loan crisis in the US, during the 1980s, Chinese banks have been reckless with their lending practices. They've heavily invested in the real estate sector, leading to significant risk exposure. On top of that, there's been inadequate risk management. Poor oversight and risk assessment have left these banks vulnerable. And the Chinese property market, once a major economic driver, is now in crisis. This downturn has put immense pressure on the banking system. Adding to the woes is China's excessive debt burden. Over the years, China's growth has been fueled by heavy investments in property and local government infrastructure projects. But now, growth has slowed sharply, with GDP growth stabilizing around 4%, a far cry from the boom years of the past 2 decades. So, what does all this mean for the United States? In the short term, the impact is likely to be limited. The U.S. has relatively minimal direct financial and trade connections with China, which helps to mitigate potential spillover effects. Even in a worst-case scenario where China experiences a hard landing, the effect on U.S. economic growth would be minimal. Experts predict it could reduce real growth by just 0.1% in 2024 and 0.2% in 2025. Interestingly, there might even be some potential benefits for the U.S. A Chinese economic crisis could reduce demand for raw materials, potentially lowering some prices. This could help mitigate inflation, which the U.S. has been grappling with. However, there are concerns about global growth. If China's slowdown persists and combines with challenges in other major economies, like the Eurozone and the UK, it could put more pressure on the US as a key driver of global economic stability. Lower commodity prices could benefit US consumers, but might harm certain sectors of the economy. And while China's deflationary pressures could help moderate global prices, the situation remains complex and dynamic. In conclusion, while the banking issues in China are significant, their direct impact on the U.S. economy and financial markets is expected to be relatively contained in the short term. But this situation definitely warrants ongoing monitoring. Prolonged economic challenges in China could have broader implications for global economic growth and stability. Thanks for watching, and don't forget to like, subscribe, and hit the bell icon for more financial insights from the Simple Truth Network. Stay informed and see you in the next video.